people, welcome back to our sessions. Today we are going to discuss section 2, chapter 1, which is types of business entities. So let's see what is the first question. Which of the following types of domestic business entities formed after 1996 must be taxed as a corporation? First one, association. Second, insurance company. Third, any business formed under state law that refers to itself as a corporation. Fourth, a single member limited liability company. Let's see the options. Option A 4 only, B 2 and 3 only. See all of these choices, D 1, 2, 3 only. Let's see the answer. The answer is D 1, 2, 3 only. Let's see why it is 1, 2, 3 only. So here association can choose to be taxed as corporation, partnership or disregarded entity. They have flexibility in how they are taxed. So association can be a corporation, and the other one, which is insurance company, are generally subject to specific tax rules and regulation. They are typically taxed as corporation under specific provision of the tax code that apply to insurance companies, and the other one, which is any business formed under state law that refers to itself as corporation. So this statement is accurate. So it referring to oneself as a corporation can be treated as a corporation. So as it is formed under state law, so it is treated as corporation. So 1, 2, 3 are treated as corporation. Single member LLC, it is by default treated as LLC. It is not a corporation. If they make an election to be treated as corporation by filing 8823 8832, so then they are treated as corporation. So single member LLC, it is treated as disregarded entity. Let's go to the next question. Most unincorporated businesses formed after 1996 can choose whether to be taxed as a partnership or a corporation. The regulations provide for a default rule if no election is made. If an election is not made and the default rules apply, which of the following is true? A. All of these choices are true. B. Any new domestic eligible entity having at least 2 or more members is classified as a partnership. See, if all members of a new foreign entity have limited liability, it is classified as an association, taxable as a corporation. D. Any new domestic eligible entity with a single member is disregarded as an entity separate from its owner. Let's see the answer. The answer is A, all of these choices. Let's see why it is A. So here, the default rule for unincorporated business formed after 1996 allows them to choose whether to be taxed as a corporation or partnership. So the default rules also include the possibility of a multi-member domestic eligible entity being classified as a partnership and single member eligible entity being disregarded as an entity separate from its owner. So the classification is not solely determined by the number of members or the presence of limited liability. So the answer is A. Let's go to the next question. A domestic limited liability company with at least 2 members that does not file Form 8032 entity classification election is classified as A. Partnership, B. An entity disregarded as an entity separate from its owner by applying the rules and regulations section 3017701(3), and C. Or a non-entity which requires members to report the income and related expenses on Form 1040. D. Corporation. Let's see the answer. The answer is A. Partnership. Let's see why it is A. So here, domestic limited liability company with at least 2 members that does not file Form 8832 entity classification election is classified as a partnership. This is because the default classification for a multi-member domestic LLC that does not make an election is partnership. Let's go to the next question. Which of the following is not a characteristics of a C corporation? A. It is permanent legal entity that has an independent existence separate and distinct from its owner. B. Its equity structure can be comprised of more than one class of stock. C. It is subject to one level of taxation. D. It must adhere to corporate formalities. Let's see the answer. The answer is C. It is subject to one level of taxation. So C corporation normally subject to two levels of taxation. First, the corporation itself is taxed on its net income at the corporate tax rates. Then, if corporation distributes dividend to shareholders, those dividends are taxed again at individual shareholders tax rate. So this phenomena is often referred as double taxation. So as option C incorrectly stating that one level of taxation is wrong. So the C corporation is subject to double taxation. Let's go to the next question. The tax advantage of which is that qualifying businesses may be treated as partnership for tax purposes. They may thereby avoiding the problem of double taxation associated with regular corporation. A LLC, B C corporation, C professional service corporation, D sole proprietorship. Let's see the answer. The answer is A LLC. Let's see why the other three options are wrong. So C corporation are not known for avoiding the problem of double taxation. In fact, C corporation are often associated with double taxation, where the corporation profit are taxed at the corporate level and then again when dividends are distributed to shareholders. C professional service corporation. Professional service corporation are typically organized for licensed professionals to provide their services. So they may have specific legal requirements and benefits related to the practice of certain profession. They do not necessarily provide a tax advantage that avoids double taxation. C is wrong. D sole proprietorship. Sole proprietorships are not typically treated as partnership for tax purposes. They are the simplest form of business structure where a single individual owns and operates the business. Sole proprietorship do not involve multiple owners like partnership. So sole proprietorship is wrong. The answer is LLC. So here LLC can elect to be treated as partnership for tax purposes. This means that income and expenses of the LLC flow through the individual member tax returns, avoiding the double taxation associated with regular C corporation. So this tax treatment is a key advantage of LLC and other similar pass-through entities. So option A is the right answer. Let's go to the next question. Domestic LLC with at least two members that does not file Form 8032 is classified as for federal income tax purposes. A subchapter S corporation, B partnership, C corporation, D sole proprietorship. Let's see the answer. The answer is partnership. Let's see why it is partnership. So a domestic LLC with at least two members that does not file Form 8832 is classified as partnership for federal income tax purposes. So this is the default classification for such an entity. Let's go to the next question. Most unincorporated businesses formed after 1996 can choose whether to be taxed as a partnership or corporation. So the regulation provide for a default rule if no election is made. So if an election is not made and the default rules apply, which of the following is true? A. All of these choices are true. B. Any new domestic eligible entity having at least two or more members is classified as a partnership. C. If all members of a new foreign entity have limited liability, it is classified as association taxable as a corporation. D. Any new domestic eligible entity with a single member is regarded as an entity separate from its owner. Let's see the answer. The answer is A, all of these choices. Let's see why it is A. So the default rule for unincorporated businesses formed after 1996 allows them to choose whether to be taxed as a partnership or corporation. So the default rules also include the possibility of a multi-member domestic eligible entity being classified as partnership and single member eligible entity being disregarded as an entity separate from its owner. So the classification is not solely determined by the number of members or the presence of limited liability. So the answer is A. Let's go to the next question. Which of the following is not a characteristic of an S corporation? A. 100 or fewer shareholders. B. More than one class of stock. C. Shareholders have limited liability. D. Generally, losses incurred by an S corporation can be used by its shareholder to offset their individual income. Let's see the answer. The answer is B. More than one class of stock. Let's see why it is B. So here, option A, 100 or fewer shareholders have limited liability, and losses incurred by S corporation can be used by its shareholder to offset their individual income, are the characteristics of S corporation. So more than one class of stock, this option is not a characteristics of S corporation, because here one of the key requirement of S corporation is that it can have only it can have only one class of stock. So this means that all share of stock in S corporation must have the same rights and privileges. So if an S corporation has more than one class of stock with different rights, it could risk losing its S corporation status. So option B is the right answer. Let's go to the next question. For federal tax purposes, a limited liability company A allows an entity to avoid unlimited liability. B must file Form 1120. C may not be treated as a partnership for tax purposes. D must have centralized management. Let's see the answer. The answer is A. Let's see why it is A. So here, this is a characteristics of limited liability company. One of the primary advantage of LLC is that it provides limited liability to its member, which means that their personal assets are generally protected from the company's debt and liability. So the answer is A. Let's go to the next question. Which of the following taxpayer is not eligible to file Schedule C? A statutory employee, B sole proprietor, C partnership, D qualified joint venture. Let's see the answer. The answer is C, partnership. Let's see why it is C. Statutory employee and sole proprietor qualified joint venture are generally eligible to file Schedule C. So option C, partnership. Partnership do not file Schedule C. Instead, the partnership typically file Form 1065 to report their income and expenses, and each partner receives Schedule K1 that outlines the share of partnership income, deduction, and credits. So option C is the right answer. Let's go to the next question. Which of the following person is not a characteristics of a qualified joint venture? A, the only member of the joint venture as married couple who file a joint return. B, both spouses materially participate in the trade or business. C, both spouses elect not to be treated as partnership. D, the business is a partnership or LLC. Let's see the answer. The answer is D. Let's see why the other three options are wrong. So A, here, this is the characteristic of a qualified joint venture. So a qualified joint venture is formed by a married couple who jointly own and operate an unincorporated business and file a joint return. Option B, this is a characteristic of qualified joint venture. Both spouses must actively and materially participate in the business for it to qualify as a qualified joint venture. Passive ownership is not sufficient. And option C, this is also one of the characteristics. To be eligible for qualified joint venture status, both spouses must have an election to on their tax return to not to be treated as partnership. And option D is the answer, because a qualified joint venture is not a partnership or LLC. It is a specific tax classification for a business owned and operated by married couple who files a joint return. So the business is treated as two separate sole proprietors for the tax purposes. Let's go to the next question. Which of the following statement is true regarding a qualified joint venture? A, qualified joint venture whose only members are taxpayer and spouse filing a separate return can elect not to be treated as partnership for federal tax purposes. B, all members of the joint venture must be family members, including brother, sister, parents, and children. C, the qualified joint venture option simplifies the filing requirement by allowing a business whose only members are a taxpayer and spouse to be treated as two sole proprietorships on a joint Form 1040 federal tax return rather than a partnership for tax purposes. The only a partnership is allowed to be a qualified joint venture. Let's see the answer. The answer is C. Let's see why it is C. So here qualified joint venture option simplifies the filing requirements by allowing a business whose only members are a taxpayer and spouse to be treated as two sole proprietorships on joint form 1040 federal tax return rather than a partnership for tax purposes. So here the qualified joint venture option allows a married couple filing a joint return to treat their jointly owned and operated business as two separate sole proprietorship for federal tax purposes. So this simplifies the filing requirement compared to treating the business as a partnership. So option C is the right answer. Let's go to the next question. A taxpayer materially participated in a business for a tax year if any of the following tests are met except A. The taxpayer participated in the activity for more than 500 hours. B. The taxpayer participated in the activity for more than 100 hours during the tax year and participated at least as much as any other individual for the year. C. The taxpayer's participation was substantially all the participation in the activity of all individuals for the tax year, including the participation of individuals who did not own any interest in the activity. D. The taxpayer materially participated in the activity for any three, whether or not consecutive of the 5 immediate preceding tax year. Let's see the answer. The answer is D. Let's see why it is D. So here option A, B, C are the requirements for material participation, and option D is not required. This is the exception because this test is not a valid test for material participation. The correct statement should be that if a taxpayer materially participated in the activity for at least 5 out of 10 last 10 years, then they are considered to have materially participated. So it is not 3 out of 5 years, it is 5 out of 10 years. So option D is the answer. So with this we have finished section 2 chapter 1 MCQs.